Do you ever find yourself hesitating to open trades? You just stare at the charts and think, it's not showing me what I need to see. Then, annoyingly, the price ends up moving exactly as you expected. It's like you're waiting for the stars to align before you take an entry. If so, this video is for you. And even if you don't hesitate with your entries, trust me, this video will help your trading anyway. Now, when we make decisions in our everyday lives, we're always weighing up the probabilities of the situation even if we don't realize we're doing it. Like if you're deciding what time to leave for work so you can avoid the traffic and get in on time. You might not know it, but you're actually thinking about various probabilities, the probability of traffic at different times and how that will affect the probability of you getting to work by 9 o'clock. The reason you are not aware of this is because we do it so smoothly most of the time. But when we're faced with difficult decisions where there is an uncertain outcome, suddenly that process gets jammed and we feel stuck. Like if you're making the decision about whether to move in with your girlfriend or not. You can't see into the future, so you don't know how she will change, how you will change, or whether it will make your relationship better or worse. It might end up seeming like there is no right decision to go for and you get stuck. It's all about the uncertainty. This is similar to what we face in the markets, and luckily there is a solution to it. But before we get into that, let's understand what the problem actually is. Before we continue, remember to check out our free Telegram channel in which every day we share useful materials, news, analysis, market strategies, and even more material in psychology. Save yourself hours and ton of money just by subscribing in our free Telegram channel. So imagine I have a deck of 20 cards. Some are red and some are blue, but you don't know how many of each of them there are. It might be 10 and 10, it might be 19 red and 1 blue. There is no way of knowing. Now I'm going to give you an option. The first option is that you can get a bet on either red or blue and turn over the next card. If you guess the color right, you will win $10, but if you guessed it wrong, you will win nothing. So for example, you might choose red, and if you turn over the next card and that's red, you win $10, but if it's blue, you get nothing. Or the second option is that you don't have to bet on anything at all, and you can just get a guaranteed $3 instead. So which option are you choosing? A guaranteed $3 or the possibility of winning the $10 if you guess correctly? Keep your answer in mind, and now let's play again. This time I will give you the same option as before, but you now know that the deck has 10 red cards and 10 blue cards, so it's 50-50. Which option are you taking now? This example is used for testing something known as the Ellsberg Paradox. As you might expect, more people are willing to take the bet in the second example. But the Ellsberg Paradox also suggests that decision makers would rather take the choice with a transparent likelihood of risk, even in a situation where the alternative would produce greater utility. You see, we really don't like uncertainty. In fact, a 2016 study found just how badly we cope with uncertainty. There was a group of participants, and some of them were told that they were definitely going to receive a painful electric shock, whereas the others were told that there was a 50% chance of them getting it. The results of the study were fascinating because the people who were definitely going to receive the painful shock were actually calmer and less agitated than the ones who didn't know whether they get one or not. The thing is, our brains actually operate differently when we're faced with uncertainty. Now, before I explain why that is, let's make an important distinction. Back in the 1920s, Frank Knight famously defined two types of situation in his book, Risk, Uncertainty, and Profit. This led to the term risk and uncertainty, which is used when there is a lack of quantifiable knowledge about a possible outcome. Essentially, we can think of the difference as this: when we can quantify the probability of an outcome happening, we can refer to it as a risk. But when we can't quantify the probability, we can refer to it as an uncertainty, also sometimes called ambiguous uncertainty. So let's go back to that example with the decks of cards. One of these decks represents uncertainty and the other represents risk. Now this card game and other similar activities were used in a study, meaning brain research. They were looking at the neural differences between uncertainty and risk, and what they found was that there were different patterns of activation in the brain. The brain was dealing with uncertainty differently than how it would deal with risk. When there is uncertainty, we see more activation in areas of the brain associated with emotional information, the amygdala. This is where we have emotional responses like fear, anxiety, and aggression. There is also a reduction in the anticipated rewards from our decisions. So in the study, they go on to say that under uncertainty, the brain is allotted to the fact that information is missing. The choice is based on the information available, therefore carrying more unknown and potentially dangerous consequences. Cognitive and behavioral resources must be mobilized in order to seek out additional information from the environment. And that basically explains exactly what ends up happening when humans are faced with uncertain situation. The optimal strategy that we use is something known as explore exploit. So exploration means searching for things or trying different choices that we're not familiar with in the hope of finding new rewards, whereas exploration means choosing an option that is now familiar and has a higher assessment of rewards and making use of that. An easy way to think about this mechanism is to consider what it would have meant for our evolutionary ancestors. In fact, we have even seen it these days with survivalist TV shows. So I'm a big fan of things like Ed Stafford or Naked and Afraid, and if you watch those shows, you will notice a consistent pattern that they follow, which I imagine our ancestors would do as well. It's basically explore exploit. So first they will explore their uncertain environments looking for where they can find resources. They try to find where there is a water source, where there is a potential for food, and where there is a good spot to build a shelter. So this exploration phase will go on for a while until they find something that's suitable, and then they will exploit the area. They will collect the resources and settle down. They don't know if there would be a better area if they explored further, but it doesn't matter. They settle and exploit what they have already found. If things are going well in the future, they will drift further afield during the day, knowing they have their main base already, so they can explore again before potentially exploiting any new resources that they find. By doing this, they turn an uncertain situation, which may eventually induce anxiety or fear in them, into one that feels much more comfortable and more certain. But the important thing here is that at some point you need to switch from explore to exploit. However, in some situations, this uncertainty is never going to go away, and when that happens, it's been found that people will continue exploring and exploring, trying to find some certainty that doesn't actually exist. This excessive information seeking can actually lead to high levels of stress and eventually burnout or in avoidance of information altogether, putting you in a much worse situation. This is what tends to happen with traders. We never know exactly what will happen next in the markets because we're not fortune tellers. So when traders are faced with this uncertainty, rather than being able to switch into exploit mode, which would mean opening a trade, they just continue analyzing and go on an endless search for information, hoping to finally come across the certainty that they crave. It's a never-ending issue, so how can we solve this problem? Well, there are two things we can do, and the answer is actually already within what we have been discussing. The first step is to start trusting some of the information that you found that appears consistent all the time, rather than trying to find certainty in things. If these are at least some things that you can exploit, you need to take those In fact, a study on expert judgment found that we used far less information when coming to a conclusion what we think we do. Most information we gather to make a decision isn't actually contributing to our decision anyway. It just makes us feel more confident in our decision since we have a large amount of evidence. But the decision itself doesn't change, so the additional information isn't really needed. In practical terms for our trading, this means having a system where you know what information you are gathering and what the exploration cutoff point is. At what point do you consistently decide that you have enough information and it's time to either cheat or get off the pot? Then the next step relates to the distinction between risk and uncertainty. We know that when we make the outcomes quantifiable, it engages different parts of our brain. We're no longer tapping into the emotional processing so much. Therefore, we need to make this happen. Now, the best way to do this is to start estimating the probabilities of the different outcomes that may happen in the market. To start with, you will probably be pretty bad at this, but you can improve over time. In fact, that's been proven. But even if you're bad at it and the probabilities are wrong, you're still solving the issue of being hesitant about opening the trade. It's no longer an uncertainty, it's a quantifiable risk. Actually, estimating the probabilities of different outcomes in the markets, like your opportunities that you're analyzing, is important to many other reasons to do with your trading as well. In fact, in my opinion, it's the most important factor for successful trading, and we will discuss that more in future. So if you think about it, those two steps that we just went through are actually tied together. You need a system for analyzing and collecting information where there is a clear cutoff point to say that it's time to stop exploring and start moving on to exploiting potentially. And how do you decide what that point should be? Whereas once you have enough information to start estimating the probabilities, this is what your trading system should be based around. And you know what? Let me leave you with a final bonus tip. This one is really important, and it's a mistake that I see most traders making. When you're assessing a potential opportunity, most traders will be asking themselves, is this trade going to end up being profitable? But it's impossible for us to know the answer to that question. By asking ourselves that question, we're facing uncertainty that's going to throw us back in the exploration mode to try and find an answer to that impossible question. It leaves us hesitating to open the trades because we can't answer the question. Instead, what we should be asking ourselves is, would this trade fit with my trading system? Is this a legitimate setup for the way that I trade? Before we continue to have more valuable insights about the market and psychology, remember to check out our free Telegram channel where we share all what we wish to have out our time. Now, what's the question that we can answer with certainty, because we're not relying on the uncertain future, we're relying on the criteria that we have laid out for ourselves. We have a system and we can easily compare whether this opportunity aligns with that system or not. And of course, if you don't have a system, then it's no wonder why are you hesitating to open trades. Now, if the trade ends up being a profit, great. If it's a loss, that's okay as well. Successful trading is about having a positive trade equation. It's not about predicting the future perfectly and being right every time you do. Then over time, we analyze our results to see if we are profitable or not. If we're not profitable, that means we need to go to work on our system so we can go through an optimization process, fix the lot flows, and change things around before going through that same thing. Thank you guys for watching this video until the end, and bye.